The Accounts Receivable Control Account shows the total amount owed to the business by all customers. It works by collecting the totals from invoices and receipts and summarising them into one single balance in the general ledger. Let's walk through the process. We start with the source documents. The invoices show how much each customer owes, including value-added tax. Receipt documents show how much they've paid. These then move into the books of prime entry. Invoices are recorded in the sales day book, and customer payments go into the cash book. From there, customer-by-customer details are posted into the accounts receivable ledger. You can see here, customer A now owes £70 and customer B owes £120. At the same time, the general ledger is updated. The revenue account gets the sales value, the value-added tax account gets the VAT, and the receivables control account receives the total amount customers owe. When customers pay, those amounts go to the bank account and reduce the receivables control account. The control account gives us one total figure, in this case £190, which represents everything customers still owe. The key point is that the total of all the customer accounts in the subsidiary ledger must match the closing balance of the receivables control account. If the two do not agree, we know there's an error somewhere. So the receivables control account is a vital check of accuracy and a quick way to confirm all customer balances are correct before we prepare financial statements. Let's look at the specific items that appear inside Accounts Receivables Control Account. Each line in this table shows a different type of transaction that either increases or decreases the amount owed by customers. The debit side shows anything that increases the amount customers owe. The credit side shows anything that reduces the amount customers owe. Opening balance brought down is the amount customers already owed at the start of the period. It appears on the debit side because accounts receivable is an asset, and assets normally carry debit balances. Any credit sales increase what customers owe. A sale on credit always goes on the debit side of the receivables control account. Returned or bounced checks. If a customer pays but the check bounces, the payment they made was never actually received. So we need to add the amount back to what they owe. If a customer is charged interest for late payment, that interest becomes additional money they owe, so it goes on the debit side. Bank receipts are money received from customers. When they pay, the amount they owe decreases, so this entry appears on the credit side. When customers return goods, we issue credit notes. Their debt must be reduced, so we record the full credit note value on the credit side. If the business gives a discount for early payment, customers owe less, so discounts appear as credits. Bad debts written off is when a customer will never pay. We remove the amount they owe from the control account. This is a credit entry because we reduce the receivable. A contra entry is used when a business is both a customer and a supplier to another company. We offset one balance against the other. If the other company owes us money, but we also owe them money, we can contra the amounts. A contra reduces receivables, therefore it goes on the credit side. Let's walk through a full example of how the Accounts Receivable Control Account works in practice. At the end of the month, we want to calculate how much money customers owe the business. Here are the transactions for the month. We started with an opening balance of £25,000. That means customers already owed us this amount at the start of the period. During the month, we made £12,000 of credit sales. Those sales increase what customers owe, so this goes on the debit side. A customer's cheque bounced for £600. That means the payment failed, so the customer still owes the money. Customers then made £18,000 of payments. These reduce the amount owed, so they go on the credit side. We issued a £1,000 credit note. This reduces a customer's balance, so that also goes on the credit side. The closing balance on the receivables control account is £18,600 debit. That means customers still owe the business at the end of the month. Let's look at why the total of the receivables ledger might not match the Accounts Receivable Control Account. If they don't match, it means something has gone wrong in the posting process, either in the customer accounts or in the control account itself. We'll look at the most common causes of these discrepancies. An invoice is omitted or entered twice. An invoice is overstated or understated. A credit note is omitted or entered twice, or a credit note is overstated or understated. Let's break each one down with simple, clear examples. Let's look at the invoice omitted error. In this example, an invoice for £150 has been recorded correctly in the individual customer's account within the Accounts Receivable ledger, but it was not posted to the Accounts Receivable Control Account. Because the control account is missing this invoice, the ledger total is £150 higher than the control account. This creates a discrepancy between the two records. This type of error is known as an invoice omission. The transaction exists in the ledger but never made it to the control account. Let's look at the invoice entered twice error. In this example, the same invoice for £150 has been entered twice in the Accounts Receivable ledger, making its balance higher than the control account. This is a classic duplication error in the subsidiary ledger, where a transaction is accidentally entered more than once. Another type of error is overstated invoice. In this example, the invoice should have been recorded at £50, but in the Accounts Receivable ledger it has been entered as £75. That means the invoice is overstated by £25 in the customer ledger. This creates a difference between the ledger and the control account and is an example of an overstated invoice in the subsidiary ledger. Another type of error is understated invoice. In this example, we have an invoice that should have been recorded at £100, but in the Accounts Receivable ledger it has only been entered as £75. This means the invoice has been understated by £25 in the subsidiary ledger. The Accounts Receivable Control Account, however, shows the correct figure of £100. Because the invoice was understated in the ledger total ends up being lower than the control account. Next type of error is omitted credit note. In this example, a credit note for £200 has been issued and correctly entered in the Accounts Receivable ledger. However, it has not been posted to the Accounts Receivable Control Account. A credit note reduces the amount owed by the customer. Since the ledger has recorded it, the ledger balance is correctly reduced to £1,000. But because the control account did not record the credit note, its balance remains at £1,200, which is £200 too high. This is an example of a credit note omission from the control account. Next type of error is credit note posted twice. In this example, a credit note for £150 has been issued, and it should reduce the customer's balance only once. However, in the Accounts Receivable ledger, the credit note has been entered twice. Because a credit note reduces the amount owed, entering it twice means the ledger balance is reduced by £300 instead of the correct £150. Meanwhile, the Accounts Receivable Control Account shows the correct posting. The credit note is recorded only once, so the control account is reduced by £150. As a result, the balance in the ledger is £1,000, while the control account stands at £1,150. This is an example of a duplicate credit note error in the subsidiary ledger, where the credit has been posted more than once. Let's summarize what we've learned. Invoices and credit notes can be entered wrongly in either the customer's Accounts Receivable ledger or the Accounts Receivable Control Account, and any difference between the two usually comes from one of these errors. Because invoices make the balance go up and credit notes make the balance go down, the key is simply checking whether the balance has moved too much or not enough. Just like invoices and credit notes, customer payments can be recorded incorrectly, creating a difference between the Accounts Receivable ledger and the Accounts Receivable Control Account. The only principle to remember is, a payment should reduce the amount the customer owes, so any mistake will make the balance either too high or too low.